October 10th, 2025. A day that will be remembered as the largest liquidation event in the history of digital assets.
The global cryptocurrencies market lost more than half of its value.
Fucking shit.
Bitcoin is down 3% today.
Within 6 hours, over $19 billion in leveraged positions were liquidated across global crypto exchanges. More than 1.6 million accounts erased in a single trading session.
Bitcoin right now at $94,632.
Blocks kept forming, transactions continued, but the myth of invincibility died that day. October 10th, 2025. The day the decentralized market learned it was part of the system it was built to escape. This was the great crypto crash, and it changed everything.
October 10th, 2025 began like any other Friday. Bitcoin opened calmly at $122,400, and at first the world seemed placid. Traders sipped coffee in Manhattan. Analysts scanned charts in London. And retail investors scrolled through screens from Tokyo to Singapore. Yet beneath the surface, a catastrophic storm was quietly brewing. Years of accrued risk, fueled by massive leveraged positions, aggressive algorithmic strategies, and highly interlinked exchanges had created an ecosystem of profound systemic fragility. One small tremor could and would trigger chaos. The foundation of the crash was built upon three structural pillars. By late 2025, the market was no longer dominated solely by retail enthusiasts. Massive institutional capital had flowed into derivative products.
Bitcoin climbing back above reaching its highest level in 2 weeks.
Futures and options markets, where traders bet on future prices using minimal collateral, had grown exponentially, creating a colossal tower of virtual value, resting precariously on a small, real base. This introduced immense contagion risk. A liquidation on one platform would instantly affect the underlying asset's price across all other platforms through arbitrage and cross-market hedges. Furthermore, the market was a synchronous 24/7 global environment, ensuring that a tremor starting in one time zone would be instantly transmitted and amplified across the entire globe. The perceived stability was merely an illusion of de-risking. The spark that ignited the entire ecosystem appeared around 8:30 a.m. Eastern Time. The first tremors were felt in Asian derivative markets. A seemingly insignificant change in a peripheral contract value caused an immediate ripple effect. High-frequency trading, HFT bots, designed to detect and exploit minor price discrepancies for arbitrage, began executing thousands of orders per second. Instead of stabilizing the market, their instantaneous automated reactions became the accelerant. The velocity problem was immediately apparent. The speed of algorithmic trading, measured in milliseconds, far outstripped the human capacity to understand or intervene. Every automated response fed into the next, accelerating volatility at a pace no human fund manager could possibly match. This created a self-fulfilling prophecy of selling pressure. By 9 a.m., Europe began to notice the dip to $121,800. This movement, though small, triggered the next, most destructive phase: forced liquidation. By 10 a.m., the initial selling pressure from HFT bots triggered a massive wave of automated margin calls across major platforms like Binance and Kraken. When an investor's collateral fell below the maintenance level, the exchange automatically sold their asset to cover the debt. These liquidations injected massive, forced sell orders into the market, pushing the price down further, which in turn triggered more margin calls and more liquidations. This was the unstoppable liquidation cascade. As institutional-sized liquidations hit, the buy side of the exchange order books thinned out dramatically. Liquidity vanished as fast as the price dropped, leading to wider spreads and a devastating freefall effect. Billions of dollars disappeared within minutes, as one London fund manager later recounted. Our systems were designed to intervene and stabilize, but algorithmic liquidations moved faster than human reactions. Stabilizing one position instantly triggered another cascade elsewhere, making intervention futile. As the crisis intensified, the physical and psychological infrastructure began to fracture. By 11:30 a.m., as the price hit $115,000, the sheer volume of frantic transactions, panic sales, margin calls, and bot activity overwhelmed the Bitcoin and Ethereum blockchain nodes. Transaction confirmation times slowed dramatically, creating a dangerous information vacuum. Traders were left in limbo, unsure if their sell orders had executed or were stuck in the mempool. This uncertainty fueled even more panic as people submitted duplicate transactions at higher fees to jump the queue. The slowdown led to irrational decision-making and further compounded the chaos. By 1:30 p.m., with Bitcoin dipping below $110,000, major exchanges were forced to implement emergency, often manual measures. Unlike traditional stock markets, crypto exchanges lacked uniform, predetermined circuit breakers that could have paused the panic. Institutional traders, facing catastrophic losses, frantically shifted assets and attempted to manually override or adjust their own algorithmic trades. By 2 p.m., priced near $107,000, the scenes were identical across all global financial hubs. New York, London, Tokyo, Singapore. All screens flashed red. All staff worked frantically, united by a shared, uncontrollable crisis. The financial collapse was not purely technical. It was driven and amplified by human psychology, weaponized by social media. Platforms like Twitter and Telegram became echo chambers for fear, uncertainty, and doubt, overriding rational analysis. Users shared live screenshots of their vanishing portfolios, and the crisis was instantly dramatized through memes and the ominous rhetorical question. The crisis revealed that the sheer velocity of automated trading had exposed a fundamental flaw in the design of modern digital markets. The liquidity shortage was not merely a side effect, it was a central mechanism of the collapse. In traditional markets, market makers are obligated to provide bids and asks, ensuring continuous liquidity. In the fragmented, permissionless crypto space, those obligations were often absent. When algorithms detected initial price drops, the rational response, encoded in their logic, was not to buy the dip, but to pull liquidity instantly to avoid being caught in a falling market. The market maker's withdrawal, executed at machine speed, created a sudden chasm in the order books, allowing the price to fall by thousands of dollars on minimal actual volume. This amplified the liquidation cascade, turning what should have been a controllable correction into an uncontrollable death spiral. This exposed the inherent decentralization paradox. While the blockchain itself proved resistant to censorship, the network kept processing transactions, albeit slowly. The centralized exchanges, which hold the vast majority of capital and facilitate leverage, were the critical points of failure. The lack of standardized protocols meant that when one major exchange suffered a technical glitch or decided to manually halt trading, it created asymmetry in information and execution, further complicating the crisis for traders operating across multiple platforms. The inability of cross-exchange arbitrage bots to reliably execute stabilizing trades due to confirmation delays meant the market lacked its natural self-correcting mechanism, leaving the system vulnerable to its own amplified fear. Moreover, the contagion was not limited to centralized finance. The shockwave immediately hit the burgeoning decentralized finance ecosystem. Many large DeFi lending protocols relied on asset prices fed by centralized oracles, the bridges that bring real-world data onto the blockchain. As prices tumbled violently and exchange nodes slowed, these oracles often delivered stale or wildly inaccurate data, triggering mass automated liquidations within DeFi smart contracts. This secondary wave of forced selling added a new layer of complexity, proving that the boundary between CeFi and DeFi was dangerously porous. Stablecoins, the supposed bedrock of digital liquidity, momentarily wobbled off their dollar peg, sparking a flash of panic that threatened to destabilize the entire crypto banking sector. The event demonstrated that the most innovative parts of the digital economy were still tethered to the vulnerabilities of centralized data and traditional market behavior. Global financial bodies could no longer afford to treat the crypto market as an isolated niche playground. The systemic risk it posed was proven to be contagious to traditional finance through shared institutional exposure and cross-asset hedging. Within days, governments moved from observation to aggressive action. Regulators demanded immediate access to proprietary algorithmic trading code and full visibility into exchange custodial practices. Central banks, previously hesitant to interfere, began accelerating their own plans for central bank digital currencies, viewing them as a necessary stable anchor to counter the volatility of unregulated private stablecoins. Analysts and economists stressed the urgent need for three key reforms. Firstly, mandatory, standardized, and internationally agreed upon circuit breakers for all major exchanges. Secondly, strict, non-circumventable limits on leverage offered to retail investors. And thirdly, greater regulatory oversight into the algorithmic trading firms themselves. The crisis demanded a unified global strategy, acknowledging that financial innovations, when amplified by technology, require a regulatory framework built for the speed of light. The spectacle of the October 10th collapse played out across every major time zone, forced a political reckoning. G20 finance ministers and central bank governors formed an emergency working group. They targeted the establishment of a unified digital asset oversight body, an international equivalent to the Financial Stability Board, but dedicated solely to monitoring cross-border crypto risks. Testimony from market experts centered on the failure of market custody and reserve reporting prompted regulators to mandate attestation reports several times daily. The crisis accelerated the development of a technological solution, the creation of a cross-exchange data protocol, CEDP. This protocol would allow real-time verified data sharing, specifically regarding margin levels and institutional open interest, preventing the asymmetric information that fueled the liquidation cascade. The goal was to build a technological firewall to protect the market from its own speed. Ultimately, the most profound legacy of October 10th was the indelible imprint it left on the investor psyche. The market may recover the lost capital, but the collective trauma of watching screens seize up while fortunes vanished remains a defining psychological scar. For a generation of traders, the phrase digital anxiety became synonymous with their exposure to global, hyper-automated risk. The day served as a stark reminder that technology, while offering unprecedented accessibility, also introduces vulnerabilities at an exponential scale. October 10th was the day the world realized that when algorithms are amplified by greed and fueled by leverage, the resulting crash moves not just at the speed of light, but at the speed of human terror. It was the decisive pivot, the moment the crypto experiment transitioned from an unregulated frontier into a critical, albeit volatile, component of the global financial matrix. Finally, the October 10th collapse had unforeseen and profound macroeconomic implications that rippled far beyond the digital asset class. The sudden, massive deleveraging event dried up high-risk appetite across all global markets, causing brief, sharp corrections in traditional tech stocks and emerging market bonds. Central banks were forced to confront the systemic interconnectedness. They realized that future financial stability reports would have to include a robust analysis of digital asset risk exposure among large financial institutions. This incident accelerated the timeline for developing sovereign central bank digital currencies, CBDCs, positioning them not just as a financial innovation, but as a critical tool for maintaining liquidity and stability when private, decentralized markets fail. Thus, the day served as the ultimate test case, forcing governments and central banks worldwide to integrate the volatile reality of digital finance into their core monetary policy and risk management frameworks.